Hi guys, this is Zahir of Sublime Trading. In this episode of Mentoring Mondays, we're going to cover stop losses. Stop losses are an essential part of good trading, but an aspect that is often poorly thought out and executed. In short, stop losses help us to position size and ensure that we do not lose more than we intend to, which for us here at Sublime is typically no more than 2% per trade. Our risk management rules have been covered in more detail in a previous Mentoring Mondays episode. Stop losses should always be used without fail. There should simply be no compromise on this. To not use stop losses is a grave mistake, and it means to have 100% of your account at risk on every trade that you take. And if your position sizing is off, then you leave yourself open to a margin call and a blown account. Like all aspects of good trading, knowing how to calculate and where to place a stop loss is simple. Before we get into how we do this here at Sublime, let's look at some of the mistakes that private traders often make. As already mentioned, not using stop losses is a grave mistake and a classic way to a blown account. This often stems from the fact that most private traders opt to use stop losses that are simply way too tight, and as a result, continually get stopped out early. The main motivation to using tight stop losses is to want to see price shoot in the direction of your analysis with huge leverage for quick and large profit. But as a result, you leave yourself open to being continually stopped out from trades prematurely. And this often ends up being the case, playing right into the hands of your broker. The saying is, the trend is your friend, but most private traders end up with their broker as their best friend, and for all the wrong reasons for you and the right reasons for them. You see guys, instant gratification is almost never rewarded in trading, and which is how private traders end up being part of the abysmal broker statistics, which suggest that a good 70%, 80% plus of private traders blow account. These are official statistics. You see, you may have done your analysis correctly and be in the right direction of the market, but if you do not give price the space and the time to move, you will repeatedly be stopped out and only be faced with losses. Frustration then kicks in and private traders then opt to not use stop losses at all. Another classic approach is to start off with a tight stop loss and then continually move it further away as price comes closer to stopping you out in the hope of a reversal. This will only play havoc on your position sizing and will also lead to large losses and blown accounts when the reversal inevitably never comes. So here is the solution, guys. What you want is a stop loss that has a double-barreled purpose. Firstly, you want a well-placed stop loss that gives price the time and space to move against you first, to then come good and to return you a profit. And secondly, if the stop loss is triggered, it then confirms you are wrong about the trade. To meet both needs, we must use wide stop losses on every trade that we place. So how do we do it here at Sublime? As trend traders, we have a simple proprietary formula that uses the daily ATR of each instrument we are trading to create a stop loss that is unique to each instrument. So, for example, the daily ATR of the euro dollar is around 90 pips a day, whereas for the pound Japanese yen, it's around 200 pips. Our formula creates wide stop losses that are unique to each instrument and allows for moves against the trend first, but also wide enough to know that when the stop loss is triggered, the trade has failed and is not just a pullback or intraday noise. In addition, not only does the formula take us out of a losing trade at the right time, but it also gives us time to assess and reverse our stance if a trend reversal has taken place. You don't want to miss out on simple profit if a trend reversal is in progress and you're still holding on to your initial analysis. The key here is really being on the correct higher timeframes, which has also been covered in a previous Mentoring Mondays. Using a formula based on ATR for us at Sublime is our preferred option, but is not your only option. In the 1980s, the turtle traders amassed millions using a trend trading strategy and the Donchian channel indicator as their stop loss. As they were trained on a breakout strategy, if price triggered them into a trade and then reversed and hit the opposite Donchian channel, that would give them enough reason to exit the trade for a loss. The setting they chose to use as their stop loss was Donchian 55. So, if you place a long trade on a breakout above the Donchian 55 high and price reverses and hits the Donchian 55 low, then it's where you exit your long trade. If you place a short trade on a breakout below the Donchian 55 low and price reverses and hits the Donchian 55 high, then again it's where you exit your short trade. Essential reading is Way of the Turtle by Curtis Faith. Another simple method to use is a moving average, such as the 100 simple moving average. It's not close like the 50 simple moving average, which is a proven level of support and resistance when price is in a trend, or wide like the 200 simple moving average, which has been used for decades, even before the internet and the tech age, to give the overall bias of the market. The key is to pick one method and to stick to it. Here at Sublime, the ATR method meets our needs. It's simple to calculate and we have developed a tool to do this for us. It's unique to each instrument that we're looking to trade, and it's wide enough to give price the time and space to move, but also well placed to confirm the trade has failed when triggered. Simplicity, patience and consistency is key to good trading and longevity in the markets with all aspects of trading, and that includes using stop losses.